Hello, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia. And if you're a funded trader or you're working hard to become one, this episode is especially for you. Today, we're going to talk about a subject that doesn't get nearly enough attention in the prop trading space: gotcha rules. Now, what do I mean by that? I'm talking about those rules that aren't always front and center, the ones buried in the fine print of a prop firm's agreement. The rules that, if you violate them, even accidentally, can instantly disqualify you, shut down your funded account, or leave you empty handed after weeks or months of solid trading performance. And here's the worst part: many of these rules have nothing to do with whether you're profitable. You could be trading like a machine, racking up wins, and still get your account pulled for something like holding through a news event or violating a maximum drawdown rule you didn't fully understand. So, in today's episode, we're going to shine a light on these hidden traps. I'll walk you through the most common violations traders make when working with prop firms, why they happen, and most importantly, what you can do to avoid them. Let's get into it. Understanding the risk control framework of prop firms. First, you need to understand that prop firms are not like your personal trading account. When you're trading with your own capital, you can take any risk you want. You live or die by your own decisions. But when you're trading with a firm's capital, their capital risk management isn't optional, it's a requirement. Prop firms enforce these rules to protect themselves. They're looking for consistent, disciplined traders who follow instructions, not cowboys trying to double accounts overnight. So the fine print exists for a reason, and it's your responsibility as a trader to know every detail of the rules before you place a single trade. News trading restrictions. Let's start with one of the biggest landmines: news trading restrictions. Many prop firms do not allow you to open or hold trades during high-impact economic news events. And when I say many, I mean the majority. Why? Because news events cause volatility. Think non-farm payroll, CPI data, FOMC decisions. These announcements often lead to price spikes, liquidity gaps, and slippage. From a firm's perspective, that's uncontrollable risk. They don't want their capital exposed to erratic price moves they can't hedge against in time. Now here's where the gotcha comes in. Firms have different definitions of what counts as news trading. Some ban positions during the 5 minutes before and after an announcement. Others extend that to 15 minutes or an hour. Some prohibit opening new positions only, while others require all trades to be closed before the event. How do you avoid this trap? First, check your firm's economic calendar. Many use Forex Factory, investing.com, or their own built-in calendar. Second, set alerts for high-impact events every single day. You don't want to be caught off guard. Third, if news trading is part of your edge, either find a firm that allows it or adjust your strategy accordingly. Never assume it's allowed unless the rules explicitly say so. Weekend holding restrictions. Next up, weekend holding rules. This one gets a lot of traders in trouble, especially swing traders. Many prop firms do not allow you to carry open positions over the weekend. If you don't close your trades by a specific time on Friday, boom, you're out. Doesn't matter if you're in profit. Doesn't matter if your trade looks perfect. It's an automatic violation. Why? Weekend gaps. Between Friday's close and Sunday's open, markets can jump due to geopolitical events, surprise headlines, or macro developments. There's no liquidity, no way to adjust positions, and the firm could take massive losses. So they shut it down before it starts. If you want to avoid this issue, always confirm your firm's cutoff time. Some require positions to be closed 2 hours before market close. Use calendar reminders to review trades on Friday afternoons. If your strategy relies on multi-day setups, find a firm that explicitly permits holding over the weekend, or adjust your system. Maximum drawdown limits. Now let's talk about drawdown limits, another major trap. Most prop firms have two types of drawdown limits: daily drawdown and overall drawdown. If you exceed either, your account is terminated, even if you recover later. Let's break that down. Daily drawdown. This is the maximum amount you're allowed to lose in a single trading day. Overall drawdown. This is the total amount you can lose from your starting balance, or sometimes from your peak equity. over the life of the account. Some firms use static drawdown, it stays fixed, while others use trailing drawdown, it moves up with your highest profit point. The trailing type is the one that catches most traders off guard because they think they're safe until they take a hit after making gains. To avoid this, keep a real-time equity tracker. Set alerts for your maximum drawdown levels. Reduce your position sizes on red days. Know whether the drawdown applies to balance or equity, and don't guess. Ask support if you're unsure. Risk management violations. Risk management rules vary between firms, but common violations include trading above the maximum allowed lot size, risking more than a set percentage per trade, often capped at 1 to 2%, trading during illiquid hours, like the first hour of the Asian session, stacking trades in a way that exceeds account leverage guidelines. To stay compliant, know the max lot size you're allowed to trade. Use a risk calculator before entering every trade. Avoid scalping or trading during thin liquidity if your firm restricts it. Stick to risk-reward ratios that align with the firm's expectations, usually at least 1 to 2. Consistency rules. Here's one that throws even seasoned traders off: consistency requirements. Some firms want to see steady performance, not one huge win that carries the whole account. If you make 90% of your monthly profit in one day, you might violate the firm's consistency model and delay or lose your payout. How do you protect yourself? Spread your profits across multiple days. Maintain a consistent trade size. Avoid taking one oversized position just to hit a target. Follow a trading schedule that aligns with the firm's minimum activity requirements. Avoiding gotcha violations, a checklist. Let's recap how to avoid all of these pitfalls. Read the rulebook, not just the summary. Every word matters. Track your trades with a journal to ensure you're within all limits. Set alerts for news events, drawdown thresholds, and position size. Ask questions. If anything is unclear, contact your firm's support. Don't make assumptions. Plan your week so you're not surprised by Friday closures, midweek news events, or peak drawdown pressure. Final thoughts. Prop trading is an incredible opportunity, but only if you play by the rules. And make no mistake, those rules are designed to trip up undisciplined traders. The best way to stay in the game isn't just to be profitable, it's to be precise. If you're looking for a prop firm with clear rules and fair structures, visit crystalballmarkets.com. Their transparency and broker-backed model gives traders a genuine shot at long-term success without jumping through unnecessary hoops. That's all for today. If this episode helped you, share it with another trader. Subscribe, leave a review, and join us again next time for more insights from the front lines of financial markets. I'm Sophia, and this is Financial Market Insights for Traders.